$78. That's how far gold just fell in a single week, from $5,097 per ounce all the way down to $5,019. And it happened while something else was quietly unfolding on the other side of the planet that almost nobody is talking about. Because the same week gold dropped $78 on paper in New York, the People's Bank of China officially confirmed it bought more gold. Again. For the 16th consecutive month in a row. And if you think that's a coincidence, I need you to stay with me for the next 20 minutes, because by the time we're done here, you're going to understand something that most investors, most financial commentators, and most people watching the price ticker on their phone completely miss. There are two gold markets running simultaneously right now. One of them is lying. And the question you need to answer for yourself today is, which one do you believe? Let me give you the full picture of what's happening right now, today, March 15th, 2026. Spot gold is sitting at approximately $5,019 per ounce as of this morning. That sounds like a lot, and it is, but here's the context. Just 5 weeks ago, on January 28th of this year, gold hit an all-time record high of $5,589.38 per ounce. Write that number down, $5,589. That means gold has now pulled back more than $570 from its peak, a correction of roughly 10% in 5 weeks. The headlines this week are calling it a crash. Social media is full of people saying the gold bull run is over, that it was all hype, that it's time to sell. And here's what makes all of that noise so dangerous. Because while retail investors are panicking over the screen price, China's central bank just officially confirmed it added 30,000 more troy ounces to its national gold reserve. 30,000 ounces at $5,000 apiece. That's $150 million of gold purchased by one central bank in 1 month. And they've done this every single month for 16 months straight. Now, before I go any further, let me be very clear about what I'm doing here. I am not a financial advisor. Nothing in this video constitutes investment advice. What I am doing is showing you documented, verifiable, publicly available data from Bloomberg, the World Gold Council, the People's Bank of China's own official reserve disclosures, JP Morgan Global Research, and CME Group. You can verify every single number I give you. I'm not asking you to trust me. I'm asking you to look at the data yourself, and then decide what it means for you. With that said, let's dig into this because the story here is genuinely one of the most important financial narratives of our time. According to Bloomberg, which reported on this on March 7th, the People's Bank of China increased its gold holdings last month to 74.22 million fine troy ounces. The prior month it was 74.19 million. The month before that, 74.15 million. They've been buying every single month since November 2024 without exception. And the total reserve figure now sits at approximately 2,309 tons of gold. For context, that represents 9.6% of China's total foreign exchange reserve assets. 9.6%. 5 years ago, it was closer to 3%. They have tripled their allocation to gold in 5 years while simultaneously telling the world their economy is fine. Now, do you think a country triples its gold allocation because things are going great? Or because they know something about the future of paper currencies that most people don't? And real quick, for those of you who haven't subscribed yet, my analytics show that about 3 out of 4 people watching right now aren't subscribed. If this kind of research is cutting through the noise for you, hit that subscribe button. It helps me know who the committed community is, and it helps the algorithm show this kind of analysis to more people who genuinely need to see it. Okay, back to the story, because it gets much more interesting. To understand what's happening right now, you need a framework. And the best framework I know for understanding gold market behavior is historical precedent. Because this exact scenario, paper price crash, physical demand surge, central bank accumulation, has happened before. And when it happened before, the people who paid attention to the physical market and ignored the paper panic came out significantly ahead. Let me walk you through 3 specific historical moments that mirror today almost perfectly. The first one is 2008. September 2008, Lehman Brothers collapses, stock markets implode, and gold, which you'd think would immediately surge as a safe haven, actually dropped. In the weeks following the Lehman collapse, gold fell from around $900 per ounce to about $730, a drop of nearly 19%. The financial media said gold was broken, that it wasn't actually a safe haven. Meanwhile, the U.S. Mint reported it had sold out of American Gold Eagle coins and suspended sales. Physical dealers had weeks-long waiting lists. People who could actually get their hands on physical gold were paying premiums of 10, 15, 20% over the paper price. And then what happened? Over the next 3 years, Gold went from $730 to $1,895. The paper price had lied. The physical market had told the truth. The people who panicked at the paper crash and sold, lost. The people who recognized the divergence and bought physical won. The second historical moment is March 2020, the COVID crash. Gold dropped from around $1,600 to $1,477 in the space of 2 weeks as leveraged traders sold everything to raise cash. Same pattern. Paper crashes, financial media calls it the end of the bull run, retail investors get scared. Meanwhile, physical dealers worldwide completely sold out of inventory. The U.S. Mint suspended sales again. The Royal Canadian Mint suspended some operations. The premium on a 1-ounce American Gold Eagle went from the usual 3 to 5% to over 15%. The paper market said gold was falling. The physical market said gold was nearly impossible to obtain at any price close to the spot. And then from that April 2020 low of around $1,470, gold ran to $2,067 by August, a 40% move in 4 months. The third historical moment is January 2026, which is literally what we just experienced. On January 28th, gold hit its all-time high of $5,589, and then it crashed, hard. According to Bullion Vault, which reported on this extensively, gold lost more than 21% from its intraday record high. Silver was even more dramatic. Silver futures plummeted 31.4% in a single day to settle at $78.53, marking its worst single day since March 1980. 46 years without a drop like that, and then boom, in one session. The financial media called it a crash. People panicked. And yet, and this is the critical thing, the physical market told a completely different story. Shanghai Gold Exchange premiums stayed elevated throughout the sell-off. Physical dealers in China were still commanding $30 to $35 per ounce above the international spot price. The paper market crashed. The physical market held. Now we're in phase 2 of that same pattern. Gold has corrected from $5,589 down to $5,019. Another $570 drop. And if history rhymes the way it has rhymed twice before in this same bull cycle, the question isn't whether gold falls further. It might. The question is what happens after this consolidation, and whether the structural buyers are still accumulating while the paper traders panic. So let's look at whether the structural buyers are still buying. The World Gold Council published its central bank gold statistics earlier this month, and the numbers are striking. Yes, central bank buying slowed in January 2026 to just 5 tons total for the month, compared to the 27-ton monthly average we saw throughout 2025. But here's what the World Gold Council specifically said about that slowdown, and I'm paraphrasing their official language here. Volatile gold prices and the holiday season may have given some central banks pause, though geopolitical tensions are likely to keep accumulation going through 2026 and beyond. They're not calling it a structural reversal, they're calling it a pause. And then came the confirmation. The People's Bank of China didn't pause. They bought again. 30,000 troy ounces, 16th consecutive month. And 2 new names entered the buying club in January. Bank Negara Malaysia made its first gold purchase since 2018, adding 3 tons. The Bank of Korea announced plans to incorporate physical gold ETFs into its foreign reserve portfolio for the first time since 2013. The base of buyers is broadening, not narrowing. Now here's the macro picture that frames all of this. According to State Street's monthly gold monitor, published with data through February 28th of this year, the US dollar's share of global foreign exchange reserves has fallen to its lowest level since 1994, approximately 40%. Meanwhile, gold's share of global reserves has risen to its highest level since 1991, around 30%. Let those numbers sink in. The dollar at its weakest reserve share in 32 years, gold at its strongest reserve share in 35 years. This isn't happening by accident. It's not because central bankers collectively decided to diversify into gold because it's shiny. It's because, according to China Minsheng Bank's chief economist Wen Bin in official statements published by China Daily, intensifying geopolitical conflicts and major power rivalry have weakened market confidence in the creditworthiness of the US dollar. His words, not mine, documented, official, from a state-affiliated Chinese financial institution. And JP Morgan isn't exactly disagreeing. Their global research team in their official 2026 gold forecast projected ongoing robust investor demand, with around 250 tons of inflows into ETFs in 2026, bar and coin demand once again surpassing 1,200 tons, and central bank purchases of approximately 755 tons for the year. Even if central banks buy fewer tons than in 2024 and 2025, JP Morgan's analysis shows they don't need to buy as many tons to maintain their desired percentage allocation, because the price of gold is so much higher per ton. That's a subtle but crucial point. At $5,000 per ounce, 30,000 troy ounces costs $150 million. At $2,000 per ounce, that same 30,000 ounces would have cost $60 million. China is spending more dollars to buy the same number of ounces. That is not the behavior of a buyer who thinks the asset is overpriced. But now let me show you what I think is the most important data point in this entire story. The one that separates what the paper market is saying from what the physical market is actually doing. Because this is where it gets genuinely alarming, and it tells you something about the structure of the gold market that most retail investors never think about. As of early March 2026, according to detailed market analysis published by Financial Content on March 9th, Shanghai, meaning the physical gold market in China, was commanding a premium of $30 to $35 per ounce over international spot prices. On March 2nd specifically, during intraday peaks, some retail gold bars in China were reportedly fetching as much as $100 over the COMEX spot price. $100 over spot. That means someone in Shanghai was willingly paying $5,100 to $5,200 for an ounce of gold on the same day that COMEX futures said gold was worth $5,000. Why would anyone pay $100 above the price shown on every financial terminal in the world? There is only one rational answer to that question. Because they couldn't get the gold at the screen price. Because the physical supply wasn't there. The paper price is set by futures contracts, promises to deliver gold later. The physical premium tells you what people are willing to pay right now, today, for metal they can actually hold in their hand. Think about it this way. Imagine you're at a car dealership. The sticker price says $40,000. But the car isn't on the lot, it's on order, 6 months away. And meanwhile, someone across the street is selling the exact same car, right now, ready to drive off the lot today, for $50,000. And people are paying $50,000. What does that tell you about the real value of that car? It tells you the actual market price for immediate delivery is $10,000 higher than the sticker price. The sticker, the COMEX futures price, is what gets quoted on every news broadcast. The $50,000 transaction across the street, the physical premium in Shanghai, is what the market is actually doing. And right now, those two prices are diverging in a historically unusual way. And here's the other side of that divergence that I want to make sure you fully understand. The CME Group's own 2026 Precious Metals Outlook noted something genuinely unprecedented about 2025. Gold was breaking one of its most reliable historical relationships. For decades, gold had a strong inverse correlation with real yields, meaning when inflation-adjusted bond yields went up, gold went down, because holding a non-yielding asset becomes less attractive when bonds pay real returns. That relationship, which analysts had modeled for 30 years, broke down in 2025. Gold surged even as real yields stayed elevated. According to CME's analysis, this suggests that the old drivers, real yield correlations and Fed rate expectations, are now being outweighed by what they specifically called geopolitical hedging and sovereign diversification. Translation: central banks and large institutions are buying gold not as a yield trade, not as an inflation hedge in the traditional sense, but as a hedge against the financial system itself. That's a fundamentally different kind of buyer with a fundamentally different motivation, and they don't sell when the paper price dips. Now let's talk about the mechanism. How does this actually work? Why would paper gold prices crash while physical demand stays strong? And is there something deliberate happening here, or is it just market mechanics? I want to be careful here because I don't want to speculate beyond what the documented evidence supports. What I can tell you is what the data shows, and you can draw your own conclusions. The paper gold market, COMEX futures, operates on leverage. Traders put up a fraction of the contract value as margin and control enormous positions. According to analysis published by goldsilver.com this week, the sharp drop gold experienced in recent weeks was described as exactly this: paper traders flushing positions. Their language was specific. Gold initially spiked from $5,296 to $5,423 on geopolitical news from the Middle East, then reversed hard, down more than 6% from the intraday high. Paper traders flushing positions. Nothing more fundamental than that. When you have leveraged traders who borrowed to buy paper gold contracts and the price moves against them, their brokers issue margin calls, demanding more cash immediately or forcing liquidation. Those forced liquidations create selling pressure that has nothing to do with the actual supply or demand for physical metal. It's a cascade of financial obligations, not a judgment about gold's value. Meanwhile, What happened to physical gold during that same flush? Goldsilver.com reported explicitly, physical gold premiums stayed elevated. Demand from stackers, jewelers, and institutional buyers held steady. The physical market, where actual metal changes hands, told a completely different story than the futures screen. And they made a point that I think is one of the most important things any gold investor can hear. You cannot get a margin call on a gold coin. Nobody can force you to sell at the worst possible moment. That distinction between paper gold and physical gold isn't a minor technical detail. It is the entire reason these two markets exist simultaneously, and it's why they diverge at the moments of maximum stress. Let me show you one more piece of data that I think is genuinely important. According to JP Morgan's official research, their 2026 gold price target is $6,300 per ounce. Deutsche Bank sees $6,000. Both of those targets were set before the recent escalation of Middle East tensions. JP Morgan's precious metals strategist Natasha Kaneva has called gold their, and I'm using the World Gold Council's paraphrase of her public comments here, highest conviction long. Highest conviction long. From JP Morgan, the largest bank in America. Meanwhile, according to analysis published by State Street through February 28th, global gold ETFs saw $77 billion in inflows this year, adding more than 700 tons to holdings. $77 billion flowing into gold investment products in under 2 months. And yet the paper price shows a crash. Does this make sense to you? Because it shouldn't. Now let's make this personal, because that's ultimately the only reason any of this matters. What does all of this mean for you, right now, in practical terms? And let me be completely transparent. I am not a financial advisor, this is not financial advice, and you should absolutely do your own research and consult with a licensed professional before making any financial decisions. But here's what the data is telling me that I think you should at minimum be thinking about. First, if you've been watching gold and thinking you missed the train, these corrections are the windows the data historically shows have been entry opportunities, not exit signals. The goldsilver.com analysis I referenced puts it plainly. For someone holding physical coins or bars, flush events like the ones we just saw are noise. For someone holding leveraged paper positions, they can be catastrophic. Those are two completely different experiences of the same price move. Second, the PBOC's 16-month consecutive buying streak matters enormously for the structural floor of this market. China now holds 2,309 tons of gold, representing 9.6% of its $3.2 trillion foreign exchange reserve. That's a floor created by a sovereign nation with effectively unlimited purchasing capacity in dollar terms, buying every single month regardless of price. When you have that kind of structural buyer in the market, dips get bought. That's not speculation. That's what the 16 months of data show. Third, watch the Shanghai premium. If physical gold in China is trading at $30 to $35 over international spot, that's elevated demand. If that premium starts narrowing towards zero or going negative, meaning Shanghai is below the international price, that would be a genuine signal that Chinese demand is cooling. Right now it's not, but that's the metric to watch. Fourth, the broader global reserve shift is not reversible on a short timeline. The dollar's share of global reserves fell to its lowest since 1994. That didn't happen in 1 year, and it won't reverse in 1 year. The structural reallocation out of dollars and into gold by central banks around the world, from China to Malaysia to Uzbekistan to Brazil, is a multi-year, multi-decade process. JP Morgan's numbers show central banks are expected to buy 755 tons of gold in 2026 alone. 755 tons. At $5,000 per ounce, that's about $121 billion of institutional buying from central banks in 1 year. Fifth, mine supply is not expanding quickly enough to meet this demand. The World Gold Council's data shows global mine production growing at roughly 1 to 2% per year. Newmont, the world's largest gold miner, recently cautioned investors about a production trough in 2026. CME Group noted in their 2026 precious metals outlook that silver is now in its 5th consecutive year of physical market deficit, meaning industrial and investment demand is exceeding mine supply every year. Gold's supply picture is less extreme but similarly constrained. New mine projects take 7 to 10 years from discovery to production. The demand surge of the past 2 years cannot be met with new supply in any near-term time frame. Sixth, the geopolitical context is not improving. The Middle East escalation that Goldman Sachs, JP Morgan, and the Light Finance analysis have all cited as a primary driver is not resolving. The Strait of Hormuz threat, which carries 20% of the world's oil supply through one of the most contested maritime choke points on Earth, remains an active risk. The US-China dynamic over reserves, technology, and trade is structural, not cyclical. And tariff uncertainty, which ING Think specifically identified as a major driver of gold's move above $3,000 per ounce when Trump's tariffs first hit, has not disappeared. Seventh, and this is perhaps the most important practical point, the difference between the paper gold experience and the physical gold experience in moments of maximum stress is documented and dramatic. In January 2026, according to Bullion Vault, when silver crashed 31% in a single day, the iShares Silver ETF saw more than $40 billion in trading volume, more than trillion-dollar mega-cap stocks Apple and Amazon combined. $40 billion in one day. That is not long-term investors calmly holding physical silver. That is leveraged paper traders in a panic. Physical metal doesn't trade $40 billion in a day. It sits in vaults and changes hands slowly, deliberately. If you want the experience of holding something that cannot force sell you at the worst moment, paper products are not that thing. Let me bring this full circle. We started with a $78 weekly drop to $5,019, and I told you that the same week that happened, China officially confirmed its 16th consecutive month of gold purchases. 30,000 troy ounces, $150 million, added to their national reserve. Those two facts, the paper price drop and the physical accumulation, are not contradictory. They are the same story told from two different perspectives. The paper market is being driven by leveraged traders responding to short-term macro signals, dollar strength, rate expectations, margin calls, profit-taking after a massive rally. The physical market is being driven by sovereign wealth managers, central bankers, and institutional buyers who have a multi-year, multi-decade investment horizon, and who are making a calculated bet that the global monetary system is in a structural transition away from dollar dominance. The people who didn't understand this in 2008 panicked when gold dropped 19% and sold at the bottom of a cycle that would subsequently produce a 150% gain over the next 3 years. The people who understood what was happening bought when the paper price said sell and the physical market said buy. That pattern played out again in March 2020. It played out again in the January-February 2026 crash. And here we are, looking at it again, with gold sitting at $5,019, $570 below its all-time high, while China's central bank keeps buying every single month without exception. I'm not telling you what to do. I'm showing you the data, telling you what the largest institutions in the world are doing with that data, and asking you to think carefully about what it means. The people who were positioned before those historical moves didn't have special insider information. They had the same publicly available data that I just walked you through. The only difference was they were paying attention. Drop a comment below and tell me this. When you look at the paper price crash and the PBOC's simultaneous accumulation, do you trust the screen or the vault? I read every single comment. Your perspective genuinely shapes what I research next. And if you haven't subscribed yet and this analysis has been valuable to you, now is the moment. Hit subscribe. The next video is going to cover something that connects directly to everything we talked about today. The silver market's 5th consecutive year of physical deficit, and what that means for the gold-silver ratio going forward. You don't want to miss that one. Stay sharp, stay informed, and I'll see you in the next video.